Okay, now let's continue. Let's see what else we have in the book. And certainly, if we have time today, we'll be moving towards profit and loss as well. Okay, right. So, are you ready? Should we start? Okay, are you ready? Should we start? Can you hear me?
Hello.
Okay, can you hear me?
Yeah, just one
Okay,
moment, please.
sure.
We're here. Sorry.
Okay, let's start. Not a problem, no issue. We'll just finish all these things, the theoretical things from the book, because we have already discussed them from the notes, but still we have to read a little bit of detail. Certainly, if we have time today, we will start profit and loss, right? If not, we will just keep it till financial position. And tomorrow's day will be starting the profit and loss. Okay. Now,
Okay.
first of all, let's see this intergroup trading. So this is the same as intercompany transactions. So the parent and subsidiary may well trade with each, leading to the following potential issues to be dealt with. So the first issue is that receivables and payables of parent and subsidiary that effectively cancel each other out because they're happening within the same company, right? So again, it's the same thing that I explained you. We have to eliminate them each other. Okay. Now, dividends paid by the subsidiary recognized as income by the parent. Similarly, if a dividend is paid by one entity received by the other, the net effect of this is a group to the group is zero, right? So the same thing happening, like receivables and payables also have a net effect as zero. So instead of including that, we just eliminate that, so that only looking at receivables and payables balances, it does not overstate or understate. Okay, so we just in the safe side just eliminate them, right? Now similarly, the unrealized profit on sale of inventory between parent and subsidiary. So that you can understand this concept, consider the following question: can you make a profit if your right hand sells goods to the left hand? Obviously not, right? So the same thing I explained to you, right? Because it is
Yeah.
happening within one person, within one company, right? Okay, so these are basically current accounts, nothing special over here. This is just telling that a receivable of one company is the payable of other company, and vice versa as well. Like a payable of the subsidiary company will be the receivable of parent company, right? So this is just making you understand that. Let's take a look at this example. This is illustration 7, right? And let's see what it has done over here. So this is the whole question. Normally you will not be given in the exam this much of questions, because this is just for explanation, right? Most of the things in study text are just for building your understanding, not for testing you in exam, right? For testing in exam, the exam kit is more necessary. Okay, so all of this information is given. Let's read the requirement over here. So calculate the consolidated receivables and payables figure of P group at 30th June 2018. So we have to calculate receivables figure and payable figure. So yes, this can be one thing that may be asked to you in the MCQ, but it will not be so much long. Just maximum 2 or 3 things will be given to you, right? So that's why I was emphasizing on learning the workings and the formats separately, like a standalone, so that you will be able to do the MCQs as well and the section B questions as well. Okay, so over here for this you need to know what is the receivables formula, this whole 4 or 5 things, and the payables formula as well, which is over here, right? So same thing we have to apply over here. Let's see in the question what it has given to us. So first of all, you can see these are the individual financial position of parent company separately and subsidiary company separately. Consolidation has not yet happened, right? So they have just given the separate statements for all of these. Now we are calculating the receivables and payables, right? So receivables, you can see these ones, these amounts, 1400 plus 650. Okay, so let's calculate for the parent first. What we do is, sorry, let's calculate the receivables first. This is receivables. So 1400 plus 650, and let's see if there any intercompany transaction or anything else, right? Now P acquired 75% of S on 1st July 15 when the balance on S retained earnings was 1150. P paid 3500 for its investment in the share capital of S. So most of the consolidation questions will start like this. In the MCQs, these things will be given to you as well, just to show that this is a consolidation question. So you can see that parent is purchasing 75% of S. So obviously it has control over it because it is majority, right? Now the cost of investment is given over here. This will be given to you if you are obviously calculating the working three. But in this case, we are not requiring it, right? Retained earnings at acquisition are also given over here. Further things we will understand it from the kit. Now at the reporting date, P recorded a payable to subsidiary of $400. This agreed to the corresponding amount in S financial statements. So for parent, it was a payable. For subsidiary, it was a receivable. So we will have to take out this 400 from receivables figure as well and payables figure as well, because it is an intercompany balance, right? So this is the information will be given. It's very simple. What we do, minus 400 over here. Okay, now let's see what else we have given. At the date of acquisition, it was determined that subsidiaries land carried at cost of 2500 had a fair value of 3750. So this information is regarding that fair value adjustment. Again, it's not required, it's just a question, so it's just fulfilling the formality, right? But in this case, just sliding from the topic a bit, 2500 is the carrying value, right? And 3750 is the revalued amount. So I think 1250 will be the amount which is the fair value adjustment in this case, right? Now at that date, subsidiaries plant was determined to have a fair value of 500 in excess of its carrying amount. The fair values had not been recorded by subsidiary company, right? So this is the increase in the land figure, right? This is increase in land, and the other asset is also given, which is this, what was it? Yeah, it was plant. So plant's fair value adjustment is 500. We will have to add this. These both are relating to subsidiary, right? Not the parent. So the subsidiary working, the dedicated working is working two. In working two, we will have to add the fair value adjustment, which I have not written over here yet. I will make another format and send it to you over like today or tomorrow, because I told you there are some things that are left, right? Now P group uses the fair value method of the non-controlling interest. You can see this is the NCI, the fair value of NCI. This will normally be given to you at the end of the question. Basically, it will be the last sentence or the last line. Okay, but over here we just have to find the receivables and payables figure, right? So you can see that the answer, it has done the same thing that we did above. 1400, this was subsidiary figure. This was parent one, this was subsidiary one, and this is the intercompany balance. So the total is 1650. Similarly for payables, if I show you over here, you can see payables are over here in the current liabilities, because if there is nothing else written in current liabilities, we assume it to be payables. Because there are only two things, payables and overdraft, right? So 2800 and 1300, we add these and we minus the 400. So same thing as it has done over here. So payables balance is 3700. So it can ask you line by line as well. Like this may be a question of 2 or 3 or 4 marks, right? Maybe in the MCQs it has asked for 2 marks, right? And it can give you as a full format, like a drop down menu in section B question as well, right? So this requires a thorough understanding of formats as well and the workings as well.
Okay.
Now, this is some more detail regarding the unrealized profit. Let's discuss this as well, right? So profits made by member of a group on transactions with other group members are recognized in the accounts in individual entities concerned. Now, this is very important thing, okay? What happens is that the URP, the unrealized profit, there are two aspects to this, okay? The first aspect is that the individual companies may be making their own statements as well, We are just talking about consolidation, right? But individual company, P company may be making it for their own, right? S company may be making it for their own purpose. The individual one, not the consolidated one. For individual one, always remember it is an individual income. For the unrealized profit is added in between these statements, like normally we do in the normal accounts, right? But for the terms of group as a whole, it is written over here, for the consolidation, such profits are unrealized and must be eliminated from the accounts, right? So again, there is this explanation. Remember, you cannot make profit if your right hand sells to your left hand, right? So in the individual statements, we have to include this profit just like normal, but just for the terms for consolidation, the group accounts, this is not permitted. We have to eliminate it. Okay, so such unrealized profits arise when one group entity sells good to another group entity. Those goods have not been sold on externally by the end of the year. So so the thing over here is that we are just looking at the remaining inventory. In other words, it is the same explanation, right? They are therefore known as unrealized profit held in inventory. So if you need to remember if you need to understand the definition from the study text, it is this one from here till here, and it has exactly the same meaning as I told you, right? So only the goods that have not been sold on externally, like in other words, the remaining ones, only the unrealized profit is calculated and eliminated for them. Okay, now when one group entity sells goods to another, a number of adjustments may be needed. So current accounts may be cancelled. Current accounts means that one receivable and one payable, they have to be net off, right? Then where goods are still held by one entity at the reporting date, unrealized profit must be cancelled. So now this can be for the parent as well, and this can be for subsidiary as well. This has two cases: if parent sells to subsidiary, right, and if subsidiary sells to parent, right? So if parent is selling to subsidiary, who will be earning the profit? The parent, right? And vice versa. Similarly, if subsidiary is selling to the parent, now who is the owner of profit? The subsidiary. So in this case, subsidiary will have to account for unrealized profit. In this case, the parent will have to account for it. Okay. Now inventory must be included at original cost to the group. We already know this. Okay, now this is the same adjustments again. This is much longer steps. That's why I was avoiding this, just to tell you the simple treatment that I wrote in the notes, right? So if the seller is parent, let's read this one. This one is important. If the seller is the parent, so in this case, this first one, if parent is selling to subsidiary, what is the double entry we do? Debit group retained earnings, credit group inventory, right? I will explain this in future as well. So the reason again I'm coming to that point, that the reason I asked you to leave 2 or 3 lines in every working was this reason, basically, that as we move forward we come across new things, right? And this first new thing is this one, that if seller is the parent, we are reading the unrealized profit, right? If seller is the parent in working 5, what we do is we deduct it, we minus it, we minus the unrealized profit, right? And we credit the group inventory, because as you can see, this is the entry in inventory. You can see the PURP has been minused, right? Now this happens when the parent is a seller. Now when subsidiary is the seller, what happens is the profit element included in the subsidiary accounts, obviously, because now the subsidiary is the owner of the profit. Now what is the adjustment in this case? Debit subsidiary retained earnings, which is basically working 2, right? And credit group inventory. So here basically what happens is that there are 2 separate cases, and the thing that I told you, that working 2 is dedicated to subsidiary, working 5 is dedicated to parent, that things comes in place right here. Okay, right? So in the parent to subsidiary one, what happens is, let me write this in the notes as well, because this is an important addition. This is regarding the unrealized profits. Unrealized profits. So this is basically case number 1. 1 second. Case number 1, right? So case number 1 is that if parent is selling goods to the subsidiary company, right? So what happens is we have to do debit group retained earnings, which was basically working 5, right? And credit, we have to do inventory in this case. right? But the case number 2 over here is that if, let's say, the subsidiary was the seller and it is selling to the parent. So in this case, what we do, debit, we do working to, which was net assets. Let me write the full form: net asset of subsidiary. But this will be at reporting date, because we don't deduct the unrealized profit at acquisition date. Is the reason because at acquisition there will not, the company will not do like this, like if I purchased the subsidiary company today, I make start making transaction just for from this minute, this very minute. This will not happen, right? It does not make sense. So this is, that's why only written at reporting date side, not at acquisition date. Okay, only the unrealized profit. And credit we do over here, inventory. Okay, so these are the double entries. I've written this in the notes. If you need to revise them, you can look these from here. Okay, got it? Clear?
Yeah, this one is a bit like, yeah.
Yes, I agree. This is a bit confusing, but when we'll move to the questions, hopefully you will be much clear about this, because again, the practice is the key over here. Okay, right? Okay, let's see what else we have over here. So there is no need to do all these long examples. We'll just move to the exam kit questions if there is time. Yes, this is the last thing. Let's see. Yeah, this is the last topic of this financial position, which is mid-year acquisition. So let's read this as well. So if parent entity acquires a subsidiary at mid-year, the net assets must be calculated at the date of acquisition. So this is again the same thing, we have already discussed it. Let's say if the year end was 31st December, this is the year end, right? And let's say the year start would be obviously which one? 1st January, right? And let's say the parent company acquired the subsidiary company at 1st April, right? So you can see this is clearly a mid-year acquisition. This did not happen at the end of the year, not at the start of the year. It happened within the year, in the middle of the year, right? So that's why this will be the acquisition date. For calculating the working to, we will write acquisition date at 1st April, right? And the year end, the reporting date will be this one, 31st December. Right? So this means that the company has been with us not for the whole 12 months, not for the whole year. That means this will, I think, just be 9 months, right? April to December. Yeah. So 9 by 12 we'll do every item, but that is not for financial position, just for profit or loss. That's why it has just 3 paragraphs over here. The same topic in the statement of profit or loss, when we study it from there, it has a much larger explanation, because over there we have to do everything. We have to apportion sales, purchases, every item, cost of sale,
So
expenses, other income.
this calculation, of the months is just for the profit and loss, not for the statement of financial position.
Yes, for the financial position, it's just limited to the working to, right? In working to, we just have to keep a mind on the dates, keep an eye on the dates, the acquisition and reporting, but we don't have to do any 9 by 12, 8 by 12. We don't have to apportion it.
Okay.
Okay, right. Now, net assets at acquisition can be calculated at net assets at the start of subsidiary's financial year plus the retained. Yes, this is one important thing. Now, let's say in some questions, you encounter a situation in which this subsidiary company's information is given at 1st January, right? But for working to purpose, we have to take the acquisition date, right? The acquisition date is actually 1st April. So that means information is given at 1st January. We will have to move forward from 1st January till 1st April, so that we are ready with the amounts that are needed for working to. Because in working to, we cannot include the 1st January dates, right? And there will be certainly some kind of change in these 3 months, right? So for moving to this acquisition date, we will have to move forward in this date. And this also I'll explain you when we'll go to the questions, because this is such topic that is not that cannot be explained in theoretical terms. Okay, when we will have some kind of financial data, I'll be able to explain you much better. Okay, right, got it. So this is the end of the chapter. After 2 consecutive productive classes, we have finished the financial position, which was the first part. Now profit or loss will be much simpler for you, because you already know all the things like non-controlling interest. The format I will send you over this day, right? And other things you already know. So it will be much simpler, and hopefully it will be done in half the time we did this chapter, because we are now aware of everything in consolidation. right? So these are
Okay,
all
so
the
tomorrow
items.
we are going with the statement of profit and loss,
Yes,
right?
yes, exactly. But we first have to do just small amount of questions of this financial position in this class, right? So just 10-15 minutes I'll spend more, 5-10 minutes. And after that, we'll be looking at profit or loss tomorrow in tomorrow's class.
Okay.
Okay.
Mhm.
Now let's move in the questions. Let's see which question is of financial position and of profit or loss. So again, I was telling you that this can be tested in both section A as well and section B as well. So section A is more scoring, but I would say both of them are very much scoring if you're clear about the concept, right? Because in section A you get 2 fixed marks for every MCQ, and in section B you are able to score more as well because it's a full 15-mark question. Okay. Now let's see which one. Yeah, let's do this question. Let's do 2 or 3 questions, and after that we'll probably end. Okay. So this is the first question of Kaplan Grit, and this is for the statement of financial position because that is what we have studied till yet. Okay. Now let's read the requirement over here. Now you'll basically see that all of the things we have studied are applied over here. It's very simple. Okay. Now in consolidated statement of financial position of Yogi and its subsidiary Bear. So Yogi is the parent, Bear is the subsidiary. At 31st December, what amount should appear for goodwill? So in short, what we have to do is we have to calculate working three in this case. So most of the
Yeah.
MCQs will ask you to calculate separate workings. Not all of them. Some might ask you about working for NCI. Some might ask you to calculate working to acquisition date. So there are very much mix and match of questions. Okay, now we have to read the dates and the questions, both things very carefully because there can be very much confusion by the examiner as well. Okay, now at 1st January 2014, Yogi acquired 80% of share capital of Bear for $1.4 million. That means that Yogi is the parent, Bear is the subsidiary over here, right? So this is the cost of investment that is given, and usually it is given in every question, right? That Yogi, when it took out its wallet from the pocket, it took out for $1.4 million to pay for the subsidiary. Now this amount has two things. Remember, net assets as well and goodwill as well. But that's a more detailed thing. Obviously, this is the first question, right? Now at that date means that at the acquisition date, because this is the acquisition date. I'm
Yeah.
labeling stuff there and then because it's easy to understand. Okay. At that date, the share capital of Bear consisted of 600,000 equity shares of 0.5 each. So, you know, you remember when we studied the capital structure chapter, this is the nominal value, right? And its reserves were 800,000. So reserves are everything like revaluation reserve, retained earnings. It's a total of that. Okay. Now, fair value of NCI, fair value of non-controlling interest, was 300,000. So everything I think is given over here. We can easily calculate working three over here. Okay. So in working three, if you remember, first of all, we had to write cost of investment. Right. Now in cost of investment, it's given over here in the question. It's $1.4 million. Right. So 1,400,000. This is the first thing. Right. Now, if you're confused about the workings, you can open it in front of you. I've already sent you the notes, right? So in working three, first was cost of investment. Second one was fair value of NCI. We add this as well, right? So fair value of NCI is given over here, 300,000, right? 300,000. And lastly, we just minus one thing, which was net assets of, in this case, it's Bear, right? The subsidiary of Bear at acquisition date. Okay, and these we will have to calculate. Let's see, let's calculate them over here. Now for net assets of Bear, we are just calculating at acquisition date, so there is no need to make two columns over here because we just need the acquisition date. There are three things over here, four things: share capital, share premium, right? And then the other reserves, which includes the revaluation reserve, retained earnings, all of that, right? Now, what was the share capital at acquisition date? It's written. Look, share capital of Bear consisted of 600,000 shares. This is the number of shares. For converting it in monetary value, what we do is 600,000 into 0.5. right?
Yes.
This is what we do. So this will
Yeah,
give
yeah.
us $300,000 because this is the per share value. So this is 300,000, and I don't think there is any kind of premium, so I'll leave it at 0. Let's check again. Yeah, there was no premium, and the reserves were 800,000 at acquisition date.
If there was any premium, we had to add that, right?
Yes, 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 exactly. We had to add it, right? And one more item that I told you was that share capital and share premium would remain exactly same at acquisition date and reporting date. And the logic for that was obviously now the companies is right. Now Yogi has purchased beer, so no one else can invest in it apart from the permission of Yogi, right? So the share capital is not deemed to change over here. Okay, this is just for acquisition. So 800,000 plus 3, this gives us, I think, 1100,000, right? Yes, this is the amount. So this 1100,000, we will have to deduct it over here. 1100,000. Let's see what is the answer we're getting. So 14 plus 3 is 17, and 17 minus 11 is 6. Yeah, 600,000. So the answer is for goodwill is 600,000. This means that out of this 14, this is just a add-on thing. Out of this 1.4 million, 0.6 million, and in other words, 600,000 is the extra amount that we paid. This is basically the brand name of beer in the whole world that we encashed it and paid it extra, right? Because this is made up of two amounts, right? The net assets and the goodwill. So both of this we add and we get this amount. Okay, so the answer over here is option A, 600,000. Okay, got it. So if you remember the formula over here, and obviously for remembering it, I would not suggest to memorize it. At first, yes, you will have to, but when you do the questions, believe me, it is very, very clear. It will be very clear in your mind when you start practicing the questions. Okay. Now let's see, is this a thing? Yeah, this is for financial position as well. Let's do as well this one. 364. In consolidated statement of financial position of Tom and its subsidiary Jerry. Okay, so fascinatingly, this is Tom is the parent and Jerry is the subsidiary, right? At 31st December 2019, what amount should appear for group reserves? So group reserves is basically working 5. In other words, it is group retained earnings, right? That working we have to calculate. Now let's read this scenario. At 1st January 18, Tom acquired 80% of share capital of Jerry of 100,000. So if 80% Tom is acquiring, what percentage is the NCI, the non-controlling interest? 20%, right? The other one. Now at that date, the share capital of Jerry consisted of 50,000 equity shares. This is all information regarding the acquisition date, right? Of $1 each, and its reserves were 30,000. Okay. Now at 31st December 19, at the reporting date, the reserves of Tom and Jerry were as follows. Okay. So this is the reserves, which means, in other words, reserves is called retained earnings as well. Okay. So for the retained earnings for the Tom, for parent was 400,000, and for Jerry it was 50,000. Okay. Now for working 5, let's make a format. First, if we remember, we wrote over here parents retained earnings, right? Only the parent retained earnings. Parent in this case is Tom, right? So Tom has how much retained earnings? 400,000, right? 400,000. Now we added one thing as well, and that was Tom's share of post acquisition profits, right? This is that we added in this amount. Now we will have to find the post acquisition amount for this as well, and for post acquisition we will have to make working 2 over here, right? Let's make a working 2, which is very simple. So again, net assets of Jerry. This is the subsidiary, right? Net assets of Jerry. This is acquisition date. This is reporting date. 2 columns we make. Now this is share capital, then share premium, and lastly we have reserves. So again, reserves is a short form of retained earnings and revaluation reserve. So at acquisition, you can see at that date, share capital of Jerry consisted of 50,000 shares for $1 each. So that means 50,000 into 1 is 50,000, right? So $50,000 is acquisition at acquisition date, and this remains same. It does not change, right?
Yeah.
And premium, I don't think there is any in the question, right? Now, how much are the reserves? At acquisition date, you can see the reserves were how much? 30,000. It's written in the question, right? And at reporting date, you can clearly see it is written 50,000. So 30 and 50. Okay. Now 30,000 and over here 50,000. So this will give us a total of 100,000 and this will give us a total of 80,000. And I told you the difference between them is called the post acquisition profits, right? Now, what is the post acquisition profits in between them? $20,000, right? That's right. So 20,000 is the post acquisition. That means that during the period that uh, Tom acquired Jerry, this 20,000 was the extra profit that it generated. Okay. Now, the parent's share of post acquisition profit will be basically 20,000. And what is its percentage? 80%, right? Tom has acquired 80%. So 20,000 into 80%, this will be probably 16,000, right? 16,000. Sorry, just ignore this one.
Sorry, why 80%? Oh, is there? Okay.
I'm sorry.
No, I was just, wondering 80%. Yeah, is there is in the exercise. Yeah.
Okay, right, sure. So these two things we add, there is no kind of any unrealized profit, anything else, because these are just the introduction questions. When we add these both amounts, this is 416,000. Okay, and this is the group retained earnings figure of working 5. Okay, so the correct answer over here will be option C, 416,000. Okay, right, got it clear?
Yeah.
Okay, that's great. Now let's do this last one. Again, we have to calculate the goodwill over here. Let's skip this one. Let's do 366 because goodwill one, we have already done it above, right?
Yeah.
Let's do the working for one. This is the non-controlling interest one. Now 366, in consolidated financial position of Gary Group, what amount should appear on non-controlling interest? So this is basically working for. Okay. Now, at 1st January 2016, Gary acquired 60% of share capital of Barlow for 35,000. This is cost of investment. So at that date, share capital of Barlow consisted of 20,000 equity shares of $1 each. Reserves were 10,000. Okay. This information is given at year end, this one, reporting date. So these were its reserves at year end, 40,000 and 15,000. Right. Now, at date of acquisition, the fair value of NCI, the fair value of non-controlling interest, was 25,000. So we just have to add two amounts, if you remember. First one was fair value of NCI for working for, right? And this is given 25,000 in the question.
Yeah.
Second one was basically the NCI share of post-acquisition profits, right? NCI share of post-acquisition profits, right? This is just a short form, but it means the same. Now for this one, obviously we need post-acquisition profits, and for post-acquisition profits, we will have to make working 2, right?
Yeah.
Now let's make working 2. So this is net assets of Barlow. This is the subsidiary, right? Now let's see. So acquisition and reporting. So over here, share capital, then share premium, which I don't think is any, and then reserves. Okay. Now share capital is over here, 20,000 equity shares of $1 each, right? So that means the answer is 20,000. So 20,000 over here, and at reporting this remains the same as well. There is no share premium, so I'll leave it as 0. And reserves, you can see at acquisition it's written in the start 10,000, and at reporting date it's 15,000 for Barlow, right? We don't have to take the Gary one because this is the subsidiary.
Yeah.
So 10,000 is over here and 15,000 is over here. Okay, now let's calculate the total. So this will be 35,000 and this will be 30,000, right? So let's take the difference, and the difference, which is the post acquisition profits, this will be how much? 5,000.
Yeah.
Right? This is the post acquisition profit. Now we will have to add it in NCI's percentage. So 5,000 multiplied by if 60% parent has purchased, then how much there is NCI? 40%, the other one.
Yeah.
Right? So 5,000 into 40%, which is probably 2,000. Yeah. right? So if we add these both amounts together, we will get the final answer as 27,000. And this is the working for answer of non-controlling interest. That is option B, 27,000.
Okay.
Okay, got it clear. So we have done 3 questions of this, and I think it's enough for today. The remaining questions we'll probably do in the next class. I'm not giving you any homework because we are just very fresh in this topic, right? And I'll do
Okay.
most of the questions in the class, in the live class, and we'll most probably be starting the profit or loss in the next class. Okay, got it?